Exchange for this Monday on this rally day. Alan Nuckman from Trading Advantage is with us. Talk about oil. We got Anastasia Amoroso from JP Morgan Funds. My buddy Sarge, Stephen Guilfoyle from Deep Values there next to Kelly at Post 9, and Rick Santelli checks in from Chicago as well. Sarge, we've had this running commentary. Oil once again calling the shots. Does this rally hold for you, or just because it's expiration day, we see something else happen tomorrow? What does the stock market do about that?
You know, it's hard to see it this way right now, but I don't believe we're extremely correlated right now. Sure, we're getting a push in energy and a push in transports from the price of oil, but we're getting a nice push in everything else. And if you look at the way stocks traded on Thursday and Friday, we had mild down days, but generally speaking, they were not really risk-off days. It was more like traders were hedging their long bets rather than taking their long bets off the table. And I think we're seeing today, you can't call it parabolic, but for a week and a half now, since we hit 1810 on the S&P 500, we're moving in a pretty straight line, almost a straight line.
We're up to 1941, Alan, and between that move, the fact that the VIX is below 20, what else are you looking at in this market that tells you where we're going from here?
Well, if we want to bring in oil to an equation, it's so highly correlated with the S&P right now. I think a move above 1950 in the S&P, we've been trading sideways between, like you said, 1810 or so and 1950. You take that 150-point range on top of 1950 if there's a breakout. You do the math for me because I don't want to be the one to say 2100. But that technically looks like what we could see the asset market bottom and boost one more time. We've seen this before. We saw this in the fall. We saw this in October of 2014. So the markets have snapped back. But looking at oil, we are seeing that same formation. If it gets above 36, a quick move could be made up to 43 and squeeze people finally.
You're saying, Alan, all the coast is clear for this kind of sharp upward move that we've seen a couple of times in the last few years? You think that's what could play out now again across oil and equities?
I'm saying that it's set up technically. A push above 36 could see a nice push rally. Now, we've seen this same reversal of sentiment. If you think about what happened in the euro currency last March, you think about what happened here in gold here in December and January. The sentiment can shift quickly. We haven't seen any sustained rallies to shake out the shorts yet. So that may be coming. There are a number of things that are helping, like the dollar has relieved that currency pressure, and you're seeing other assets move up.
But Asia, you're not buying it. I mean, even with the rally we've had the last, 7 trading sessions here, you're still skeptical of this move, aren't you? Why?
Well, I am skeptical of this move because I think the fundamentals have to fundamentally improve here. There's several obstacles that the market is running into, and one of them, of course, is the big earnings obstacle. But that said, if this bottoming process that we're seeing in oil right now, if that is a real deal, then actually it does help the fundamentals too. It doesn't wipe out the default risk in the energy sector by any means, but it certainly could help boost those earnings. So we're watching the move very carefully here.
Rick Santelli, I don't want to bring up old news, but I can't stop thinking about Friday's CPI report. You know, the core, the month-on-month move was the biggest in 4 years. The year-on-year move is now, I think, the biggest in the same period of time. It was interesting to hear Scott Minerd of Guggenheim then today saying he thinks the 10-year yield is going to go down to 1%. You know, if anything, that CPI report would seem to make the case for rates at least hanging in here, right?
You know, I personally think rates will hang in, but I would never be shocked to see lower rates than we expect. And I think most of the influence or the driver that would cause that would come from outside our shores, whether it was interest rates in the Eurozone or more disarray in the Japanese economy. But I think all things being equal, I firmly believe that when you look at industrial commodities, I think they bottomed, the nickels and the coppers. In terms of oil, I wouldn't look at it the same way, but I do think that some of the really wild volatility under 30 is going to recede. So I think generically the commodities sector is most likely going to be contributing far less volatility. So I think in that setup, yes, that the U.S. economy will probably keep rates close to where they are with an upward drift versus a downward drift. And if you're looking for rates to go lower, I think you're going to have to look outside our shores. And a couple places you might want to enter, obviously with the vote on the European Union membership, the UK, the pound is getting pounded. The euro versus the yen is at a 34-month low. So I think I would check towards Japan and the Eurozone if you're looking for a dynamic that fosters lower rates in the current structure that we seem to have found over the last several sessions.
Hey, Sarge, we're back to 1940 on the S&P. I know you're a big level watcher. That's pretty constructive here, I guess. But what are you watching right now? What levels are important to you?
It's constructive. To be really constructive, though, I'd like to see us regain and hold 1942, approach 1948. If we can't get back to 1942, I think to save our really nice day here, we have to hold on to 1935.
It's interesting. I'm just still thinking about the British pound. Meanwhile, Bill, speaking of levels, you know, back at, what was it, a decade ago, when, call it almost $2 for that pound. Now we're talking about $1.40, and some people think it could be going lower anyway because of just differentials in terms of these economies. You booking that trip to London yet?
As a matter of fact, we are talking about that.
I just think, you know, these things matter. The euro, it's funny that we've gone from the euro parity argument to now all of a sudden that seems to have just held its territory, and is certainly, you know, the pound, everybody talking about going lower.
Yeah, I mean, I think the differentials are going to only magnify if the Fed starts to raise rates at some point. Anastasia, I mean, what do you think? You're the one that's, I build you as skeptical in this market, but, you know, if the Fed does start raising rates, does Wall Street embrace that, or do they fear that right now? What do you think?
I think it's a double-edged sword. I mean, yes, it is a good thing if the Fed starts to raise rates because it means that wages are rising, inflation is rising, and the labor market is tightening. So that's good for the consumer part of the economy. Already know what dislocations higher dollar has already caused. And I think one thing in particular that we may see, not necessarily the strength of the dollar versus the euro or the yen, but we could see the continued strength of the dollar versus the emerging market currencies. So that too could detract from some of the earnings of the multinational corporations. So that, and the fact that the Fed is responding to beta data, but essentially capping the potential for the S&P, I think that's where the double-edged sword comes in from. So you've got to favor consumer names, certainly, if the Fed does indeed start to raise rates. And banks, right, they have essentially discounted any possibility of rate increases. Yeah. But if that's back on the table, that could be the great opportunity.
Light a fire of sorts there. Thank you, folks. Good to